My guest today is Chase Murdock. Chase is a holdco entrepreneur and the co-founder of Decada Group. Decada Group, founded in 2020, is a long-term home for exceptional small businesses, giving them the resources they need to thrive and fulfilling the vision on which they were founded. Thanks a lot for coming to the Holdco Builders show, Chase.
Mick, it's great to be here. Thanks for the invite.
You're building Decada in Salt Lake City with Adam. Let's start with the original founder story of Decada Group.
Sure. So we've got to rewind the tapes a little bit. Adam's my best friend of 10 years. We got to know each other here in Salt Lake City because a co-working space opened up over a decade ago, before all the WeWork, pizzazz, and co-working spaces were quite rare, at least here in Salt Lake City at the time. And a co-working space opened up, and it was almost this beacon for like-minded entrepreneurs and company builders and consultants. And he and I were one of the very early members of this co-working space. And that's how we met. We hit it off as friends. And he took me and a couple of buddies down on a long backpacking trip in Capitol Reef National Park. It's one of our most beautiful national parks in southern Utah. And we went down with no plans of getting into business together. And somehow on those long, grueling days of 10 to 15 milers with nothing to talk about, we came up with the idea of starting a side small business, a lifestyle business. He and I both had a long background in entrepreneurship, and mine was primarily in venture-backed tech or tech-enabled startups. And the concept of building something intentionally small and durable as an asset was a novel idea for me. And the thinking at the time was naive. We were thinking, let's start a small business. Let's have a general manager as early as we possibly can. And if it turns off even just a few $1,000s a month in discretionary income, that's quite the enabler for pursuing a tech startup, because it lengthens your runway for which you have to raise money, which is quite a big deal when you're building a startup. The longer you can afford to avoid raising capital, the better off you'll be and the better off your company will be. And it was something like 45 days later, we swiped our first credit card of that business. We immediately got home and met over a coffee shop to hammer out the final details of the business plan. Like I said, we swiped our first credit card 45 to 60 days later, and 18 months later, we were doing $1 million a year top line. That business is now Taylor Cooperative, which is our first business in our portfolio. And so unlike the others where we've acquired them, Taylor Cooperative is our baby. We birthed it, and it was a product of a lot of blood, sweat, and tears. And it was building that company that really had us fall in love with the idea of small business and more intentional company building than I had previously done in my career.
Very interesting. Maybe you can take us back. What were the conversations about? Like, what were you discussing? I mean, when it comes to co-founding a business and having the prior experience, you both know that it's going to be extremely hard. There's going to be good days, bad days. How were the conversations? How you both could be sure that this is the right person to do it together with?
Yeah, I mean, I guess there's a lot in there of how did we come up with the idea? Why did we decide to do it? And then how did we decide to partner? I'll try to touch some of those. Taylor Cooperative is a restart of a business I attempted to start in my very early 20s. It was a company called Dress Code. And when I was 21, I had just returned from living abroad in the Philippines. And while I was abroad, I bought way too many custom suits out in Asia. If any of your listeners have traveled to Asia, they know that this is one of the many products that's hard to return home without. And it's just a phenomenal product and experience. And long story short, I ended up coming back to Utah and raising a boatload of capital and scaling out a venture-backed, tech-enabled menswear brand. Scaled it up to several states, 50 employees, doing millions a year in sales. And ultimately, and this is probably a story for another time, but ultimately got fired from the company I started, my baby. Raised a large sum of money. We had a very mature and professionalized board. And I was a 23-year-old clueless entrepreneur trying to keep a ship together. Scaling a company, double or triple digit year-on-year growth rates, and was completely in over my head. And it was a great product. It was a phenomenal experience. It was quite a learning lesson for me in my early 20s. It was a condensed MBA, let's say. And it taught me a number of things. It taught me what I liked about company building, what I liked about growth and entrepreneurship. It taught me a lot of things I didn't like, and it helped really inform a lot of my values and Decada's values today. I was telling Adam this story while we were down at Capitol Reef, and the way I remember it, at least, is Adam was peppering me with questions over, well, why didn't this business work? Why did you raise so much money? It doesn't seem like you needed to grow that quickly. What if you just slowed that growth down? It seems like such a great product and experience, was it? And it was. It was a phenomenal product and experience. And the thinking at the time was quite naive. Where our vision was, man, wouldn't it be badass to have an incredible, well-done, high-end luxury clothier in downtown Salt Lake City that reminds you of Savile Row in London, and you walk in and you feel like you're in New York and you're transported out of Utah for a moment. We don't have anything like that. And Salt Lake has been going through an incredible growth motion over the past 20 years, I would say. Post-Olympics in 2002, we've won the opportunity to host the Olympics again in 2034. Population growth rates, it's a phenomenal state to live in and do business. And what that creates is a culture of folks in downtown Salt Lake City who want to build a better Utah, a better Salt Lake, and create something that they can be part of in a small way. And that was me and Adam, and we wanted to contribute that to our city. We wanted to create something cool, something that sure could be a good business for us, but something that we could be proud to have in the community. Yeah, we went into the partnership kind of naively in the sense that we didn't sit down and redline an operating agreement together and talk about how we make decisions, what we do when we disagree. And thankfully, because of our friendship and trust, and we kind of balance each other out in some really nice ways, we've been able to mature that into a really successful 50-50 partnership over the years. I'm not a proponent of always having a business partner. Sometimes, and for some, it doesn't make sense. But for me, it's worth its weight in gold. Even just the moments where after a hard week, you could grab a beer and commiserate, having a sounding board, someone to keep my ego in check, and vice versa, I will have you know. And so it's great to have a partnership, but I've been really fortunate. And Decada is born almost as a result of having a partnership.
Now, Taylor Cooperative, what was the moment when you decided that, okay, let's buy another business? Because there are tens of thousands, hundreds of thousands of people who run one business, and 99.999 of those never go and buy another business, maybe even in another industry. What was the conversation, and why did you decide to, okay, let's start buying another businesses?
Yeah, and to be clear, and it sounds like this is what you're speaking to, we didn't go into forming Taylor Cooperative with the idea of running a holding company. I actually don't think I used the word holding company until about 4 years ago. I certainly misunderstood the concept of private equity, and just this was a whole new world to us. So I'll tell you how we kind of slipped into this world on accident. We took a lot of our passion and our fervor for building a business into Taylor Cooperative, which was not designed to be our business that we would retire on. Initially, it was intended to be a side business where we would hire people and kind of keep it intentionally small versus what I had done previously for swinging for the fences. That was maybe part of it, but of course, things never go according to plan in life. And it was much less of a side hustle than it was an all-encompassing, experience. And we really fell in love with the idea of that intentional building. I almost liken it to an analogy to help those who haven't been in small business company building before. It's almost as if you imagine a sculptor in front of a block of clay, trying to figure out how to shape this block of clay into a beautiful head bust. Year 1 and 2, you're hacking at that kind of block of clay, trying to create the shape of a head. And years 2 and 3, you're bringing out a knife and you're trying to carve into the nose and the shape of the chin. And then years 4 and 5, you're with a very fine scalpel trying to create the nuance to it. And that's very much what it felt like for us. And we fell in love with that process, and we developed a playbook that at the time we felt like was bigger than our one small business. And our business was throwing off cash flow, a good amount, but not, something to go retire off of immediately. And to us, that presented a fork in the road. We could either continue to put our eggs into this basket and reinvest and drive more growth, open more locations. We could sweep the cash flow and go buy a cabin and design this business around our lifestyle. Neither felt right. We felt like this was a beautiful business, but we didn't want to go all in just yet. And it didn't feel durable or mature enough of a business to just start kind of harvesting earnings out of it and trying to run it as a passive business. We felt like there was too much meat on the bone. It was too good of a business to do that. And so at the time, we took path one. We decided we were going to go open up a second location, and we did a lot of market analysis on our next city to expand into. We looked at pretty much every large metro area within a 3-hour flight of Salt Lake. And long story short, we concluded on Phoenix being the ideal market to open up into. And we were traveling down to Phoenix a couple times a month, scouting locations. We find a location we fell in love with, and we were negotiating over a lease agreement. And this was March of 2020, and the NBA shuts down. And we decided to postpone for a few weeks. And a few weeks became a few months. And we were sitting there with the capital and the intention and the energy to go open up a new location. And that suddenly didn't feel like the right next move. And we weren't sure what to do. And this was about the time that I started ideating on this concept of Decada Group. We called it ABC Ventures for several months while we were trying to figure out what our business model was and what to name the firm. And the things that we really liked were the idea of a very, very long-term outlook. It's always been my personal belief, or maybe not always, since my venture experiences, it's been my belief that the best companies plan in decades. And the worst plan things from one fiscal quarter to the next, trying to really kind of juice earnings and play to the market. We were really obsessed with the idea of creating meaningful companies that make a dent in our community. Adam and I decided we didn't want to live in a city where there was an Amazon pickup locker on the corner of Main and Broadway. We wanted it to be a local business, a thriving local business. And community is really made up of individuals who care about their community and business owners who play in that community. And we started to articulate some of those values. And it was around that time that we were presented a unique opportunity to acquire an art studio in downtown Salt Lake City. My ex-wife at the time, actually, she was working there and acting as the general manager. And the owners were quite successful in other ventures and felt like they were starving this business of oxygen and potential. And long story short, they approached us with the idea of acquiring their business and their real estate. And Adam and I were sitting there with this idea of, we have a great playbook. We had all this pent up capital and energy. And my God, even though that's a different business, it does feel like our playbook would really add a lot of value to that. And so we acquired the business with the model of Lucia stepping up as essentially the operator to run the company day to day. It was a dream career for her, I believe, in an industry she loves, fine art, and with the support of a holding company model. And at the time, our thesis was no small business can afford a CFO. And if they can, they definitely can't afford a CMO. HR and payroll and legal and all of the back end were things that Adam and I really were able to streamline and somehow enjoy. And most small business owners, that's the last thing they want to do at the end of a busy week. And our thinking at the time was we could fractionalize those functions of the business at the holding company level and leverage the fact that the costs are shared by a portfolio of companies in order to give them an upper hand. And so we acquired Workshop SLC. We immediately got to work kind of partnering with Lucia to launch multiple new business lines and breathe that energy back into the business that it was lacking. And we were able to 4 or 5x the company in the first 12 months. It was quite a small company, but we were able to immediately just drive and unlock new growth. In the second year, we grew at about the same rate. So we turned a company that was almost I wouldn't say a turnaround because it's not like it wasn't working. It was just a sleepy business sitting on latent opportunity. And that opened mine and Adam's eyes to the idea of this could be an interesting combination of entrepreneurship and company building on the one hand, and on the other hand, investing in capital allocation, where we can kind of bridge in between both worlds. And the thinking at the time, at least, was our ideal acquisition was one in which there was an opportunity we were able to identify that either the previous business owner didn't have the time to pursue, the capital to pursue, the energy to pursue, because the business was, crafted around living their lifestyle that they wanted to live, and that we felt like we could come in and help unlock that opportunity. So it was a very meandering story. COVID has a lot to do with it. And we truly fell into this space on accident. And now I think Adam and I would both agree that we're running a company that we don't ever want to retire from. It's a very fulfilling role, what we're doing.
Listening your story here, you pretty much have been just going with the flow, and the opportunities have been coming to you instead of when you were building this VC financed business. You had a very high goals, high energy, and you just had to go and achieve those things. Question for you: you mentioned this all supposed to had to be like a side business in the beginning, and you had this goal of keeping it small. Was it because of your previous experience that because what I want to say is it's very rare of people having this VC experience and then they're just going and starting a very small business. So maybe you can elaborate here a bit, like was it because of your experience that you wanted to keep it small, or what was it?
Yeah, I mean, it certainly was. Maybe at the time I wasn't conscious to that, but looking back, with the advantage of hindsight, certainly. Mm-hmm. Some of the constraints that Adam and I have put around how we build Decada Group are we want it to be a fun day to day. We don't want to get trapped in the arrival fallacy where we're going to work our tails off for a few years in the hopes that we can, as they do in the venture back world, IPO or get acquired. We felt like that was yet another treadmill almost to get on, for lack of a better word. And not only that, when I was growing some of these companies, it's incredible how much changes when you're building a company for a desired liquidity event. It's as if everything in the company is optimized around that. For example, when you're running a tech company, oftentimes the goal isn't to be profitable. The goal is to go and hit benchmarks that are needed to go get acquired. And so a lot of the North Star of a business shifts slightly. And that's not a bad thing inherently. But I found that led to stripping the company of what I enjoy the most about entrepreneurship, which is team building, creating a culture, building a product and service that you can really take pride in and hone over time. And so we placed a lot of constraints on Decada when we founded it. We practically took a blood oath to not raise outside capital, that we would self-fund our entire journey, even if that meant we would build more slowly and buy companies that maybe were smaller or had more risk associated with them. We felt the long-term goal of being in control of our destiny, not chasing IRR targets on behalf of shareholders, and being able to craft our companies intentionally was worth a lot more than that. And I think that set us on a trajectory where perhaps Adam and I will never own a yacht in the Mediterranean. I think I can get comfortable with that, though, if that means along the way we are able to craft a lifestyle that we don't want to retire from anyway. And so the constraint of not raising capital comes with a lot of trade-offs. And I'm sure it certainly harkens back to my experiences with venture. I guess in closing on that topic, my stance, to be clear, isn't that no one should raise VC and no one should raise outside capital. I think if the company has an opportunity to create a new market, to really change the way society does something, has a technology that's innovative that will touch every potential organization or consumer, speed and scale are the name of that game. And you can't achieve speed and scale with Decada's business model. You have to raise millions, tens, hundreds of millions of dollars to fuel that opportunity. And acquiring a business often takes outside capital, and it can either be equity capital or it can be debt capital. And both have pros and cons. I think we've simply chosen to play a more conservative game using our own cash flow, using conservative debt for the sake of the advantage we perceive that to bring.
Have the colleagues or friends from your so-called previous life where, for example, people building startups, raising capital, have they started asking from you, Chase, you look so happy, no gray hair, you travel to Japan with your kid, what is it you're doing? And maybe they've started to think in a way that maybe I should build a small business and just have a good lifestyle. Has it been like this?
I think leveling it up a notch, I think to answer your question more broadly in a macro lens, absolutely, I'm seeing people that built their careers during this era of digital transformation, where tech is the technology revolution that we're living through. It's not the industrial revolution. That would have been a fascinating time to live through. We're living through the technology revolution, and many companies were built on that opportunity and raised an incredible amounts of capital, and many made a lot of money. doing that. I think the era is not over, but I think the heyday is over of just absolutely insane valuations where RSUs or stock options are given to employees. And, there was a moment in San Francisco where it felt like everyone had a few $1,000,000 in the bank due to working at Airbnb for 7 months and getting an RSU package. And that era has been over for a long time. I've spoken with a lot of people in tech who weren't maybe founders, but had a significant portion of their opportunity as a form of stock options, or as I mentioned, RSUs, that they believed to be valued at just an incredible amount, that when the company ultimately did get acquired, they realized, man, I sacrificed years of my life and career for something that didn't change my lifestyle all that much. It was probably a really great earnout, but was it worth being on the treadmill for so long and sacrificing time with my family and my lifestyle in order to go build that? And I think there is this move toward building something tangible, building something that is durable. At least that was a significant appeal for me. And so, yeah, I mean, I think in Utah, we run a happy hour. We had our latest one last night, and it brings in a few dozen people interested in the concept of search and ETA and holding companies. And it's fascinating how many are in the category of what I would call burnt out tech workers, where they were paid incredibly well. They had a wonderful benefits package. They had a really good work-life balance, but there was something devoid of purpose in their career. And they're looking to potentially utilize the funds they built to go acquire and run a small business that's in their community. So I think it is a trend. I mean, I think that, the trend that Mick, you and I have certainly seen on Twitter and elsewhere of folks coming in with enthusiasm to learn about this space, more and more search programs popping up in more and more Ivy League schools. And now it's in many university programs that aren't Ivy League schools. It's interesting. 3 years ago, I went down to a ETA conference hosted at BYU here in Utah. And it was a host of students and acquisition entrepreneurs. And I'm going to miss the accuracy on the numbers here, but there was something like 40, 50 people there. 2 years ago, it was incredible. There was 150 people there. And a few months ago was their third. And I believe they had 400 or 500 people there. And so, yeah, I think there is an appeal to this. And I think it is a macro trend, and it is an opportunity to craft a lifestyle that's maybe a little more purposeful.
Knowing what you know now, do you wish you had started earlier with this venture, what you're building now?
I don't think so. I think I needed to go through what I went through in order to really value and appreciate what we're building. I think its advantage or differentiator as a holding company, in mine and Adam's view at least, is that we have operator chops. We've started businesses. We can relate to the individuals, the founders who sell their businesses to us, and we can speak their language, and we come across authentic because we've been in their shoes. We understand what they've gone through. And so I think that's an advantage for us, is we can acquire a business and execute a playbook to operate and not just be capital allocators shrewdly looking for a good deal. We can go find companies we're excited about and help usher them into a bold second chapter. So I don't think so. I don't think, I'm grateful for where I landed. I truly believe this is what I want to spend the rest of my life doing. But I think I had to go experience other things in order to truly appreciate where we're at.
When it comes to portfolio companies, you've said that these companies represent more than financial assets. They are integral community assets. Please tell me, what type of companies do you have in your portfolio, and maybe the ballpark of top line revenue, maybe profit, number of employees, if you can share?
Yeah, happy to. So we started Taylor Cooperative, as I explained. We acquired Workshop SLC. So we started in suiting and then fine art. And the very natural progression after that is to buy a construction company, which is what we did. Very, very natural progression from suits and art to general contracting. And then we acquired their largest electrical subcontractor, Northern Electric. So two companies that are, in the trades, for lack of a better umbrella term, and then two consumer companies that are very brand focused. Each business is doing anywhere between 1 to 5 million in revenue. Our average kind of profit margin really depends on where they're at in the post-acquisition J curve. One advantage to Decada Group's model, I would say, is because we intend to own these businesses for decades, And because we don't finance them with 90% leverage and have outside equity with IRR targets, we're able to really invest in them in years 1 and 2, both in capital and in time. And it's not uncommon at all to go and invest tens or hundreds of thousands of dollars into the company, burning down EBITDA to that low J curve in order to go get it onto new tracks. So, in the very early days post-acquisition, we're doing a complete website rebuild. We're implementing technology. We're hiring a management team and plugging in an operator. We're overhauling how they acquire customers and do their marketing. We're investing aggressively into their product and service. And so we look for companies where, like I mentioned earlier, there's latent opportunity that we feel uniquely positioned to go and pursue, to be the good owners we want to be, to again, bring that company forward. And so oftentimes that means investing aggressively. So we have, anywhere between 10 to 25% profit margins, again, based on where they're at in that journey.
What do the Decada Group team look when acquiring a business? What are the, right away, like obvious red flags? What type of revenue? You mentioned already 1 to 5 million. But what about the location?
Yeah, I mean, one, it's very important for us to be building here in our home state. We're committed geographically to Utah. On one hand, that's because Adam and I don't want to spend our time on planes. But on the other hand, it's quite tactical. If something goes sideways in a company, we like to be able to be there same day. We like to foster career development with our people and our operators, and we do a lot of joint kind of cross-company events and trainings. And so we've kept our focus to Utah. We look for companies with a durable business model, meaning we're not looking for something innovative or new or an exciting opportunity to exploit, because we feel like if there's something new and innovative about it, it has the potential to not be a long-term business. And again, our model is to create multi-decade holdings. We look for business models that are simple, that we can understand, that I can explain to a buddy at the bar, and you don't have to get into the weeds of how the industry works. So that's one way in which we combat the challenge of running a diversified holding company. Is it has to be a model we understand, and we have to be able to have a great operator that we either already know or can be promoted from within the business in order to acquire and grow the company. So we've looked at all types of companies, and I think the last criteria is, again, not to be repetitive, but we look for businesses where almost like one man's trash is another man's treasure. This concept of maybe one searcher would look at this business and be like, my God, earnings are not where we want it to be. And man, they don't even know how to acquire customers. We look at that as the business has managed to be around for 20 years, despite not having those things. And we can go model out what it would look like with it becoming a Decada company.
2 questions. How do you find the businesses? And are you using brokers? And number 2, do you acquire 100% of the business?
Great question. We like to maintain really great relationships with intermediaries, bankers, brokers. We've definitely looked at a lot of brokered deals. By coincidence or not, every acquisition we've made has been organic and has come to us in some form or fashion. We found that there was tremendous value of putting our flag in the ground and saying, we are Decada Group, we believe in these things, we acquire these kinds of companies, and making it known that this is who we are and this is what we do. Adam and I are quite active on local nonprofit boards within the community. And we found that really translates to a really positive, long-term, virtuous cycle where we're having a lot of conversations over coffee with business owners who are thinking they want to sell, and we're able to educate them on maybe how the market would value their business and what to do pre-sale. And oftentimes those conversations result in, you know what, I think I want to take 1 or 2 more years to go get my company in a better position to sell. And we were able to build that relationship of trust and help guide them. And we've seen that boomerang circle back. So we haven't yet spun up an outbound search process where we're actively selecting an industry and emailing business owners and trying to acquire off-market deals, but we've managed to acquire off-market deals. That said, we've looked at a lot of brokered deals. And so, we're not allergic to the idea, but just coincidentally, they've all managed to be organic. You asked a second question, Mick.
100% of the business to acquire.
Oh, right on. Yeah, I mean, ideally,
Hmm.
yes. We do only control deals, meaning we own the majority of the cap table. And at the end of the day, our fiduciary duty is to ensure the company has the right leadership team, the right support in place for it to thrive over decades. Sometimes we allow a seller to roll equity. We had one opportunity where one business owner had to leave the state and was ready to retire and sail off into the sunset, or maybe not retire, but sail off into the sunset. The other partner was feeling excited about the prospect of stepping up as CEO and working alongside us. And so he rolled equity forward. So I think what are critical to us is that we are the majority owner. We don't just invest in minority positions because we're not investors. We are a very hands-on operating owner. And yeah, we're open to all forms of creative partnership depending on the
I
context.
guess the sellers are not typical like hardcore finance guys. So when it comes to making those deals, what acquisition multiples are we talking, and what type of equity debt ratio? How much you can share?
Yeah, we've done 2 acquisitions with debt and 2 with equity. So again, we're not going out and levering these puppies up to the highest maximum amount we can. If you look at our portfolio globally, our debt service and our debt position is quite favorable and conservative. Multiples in this space, the advantage of working in the space we work in is these are Main Street businesses, which of course private equity has no interest in. So there's no downward pressure from private equity. And we've bought some businesses on incredibly low multiples. And to be clear, that's not our business model. We're not out trying to look for a good deal. But oftentimes these businesses have been, I should say, distressed in some form or not earning the potential that we think we can bring it to. And so we're able to acquire it on really favorable terms. That the multiple looks good on the entry and it looks incredible 12 to 24 months later. And so that's kind of our business model. We're at this fork in the road, Mick, that just kind of sharing openly, where we're trying to decide is the future of Decada Group to really embrace this unique differentiator we hold as a holding company, acquiring small companies at low prices and being highly involved for 1 to 2 years and creating tremendous equity value and helping mature the business and drive growth in its early years, which is very hands-on and difficult to scale. It's hard to build a team that can do that, but it's highly valuable in the sense that we have a very significant impact financially on the business. Or do we want to utilize our playbook to move more and more upstream, or upchain, I should say, and acquire larger and larger companies? I don't think we have to pick one or the other. I think we can kind of do both. It's in our wheelhouse to be able to do both. But yeah, that's a little bit on future, I would say, is what kinds of businesses are we looking to acquire? We're a little torn on that. And I think we've operated somewhat opportunistically to date. And I think we'll continue to. If a great business comes across our plate that we would love to own, we'll work our tails off to go acquire it, whether it's a $2 million EBITDA business or a 200,000 SDE business, if we feel like we could be good owners and there's an opportunity in front of us.
How much competition has there been on those deals?
When we're trying to get a deal under LOI and emerge
The ones you've done
the buyer
so far, for example.
Well, I'll have to be honest. The ones we've done, there was no competition. They came to us, and there was absolutely no competition. The deals we've looked at since have been incredibly competitive. As search has grown, so too has the buyer population. I think there's still substantially more great businesses than there are potential buyers, and that will continue to be the case for 20 years. But it went from very, very few buyers to a moderate amount of buyers in a pretty short period of time. So we tried to get deals under LOI and have lost several due to competition. And I think oftentimes it's a situation where Adam and I are scratching our heads wondering how could anyone possibly justify paying more than our offer price? Like, we just can't fathom. And that's maybe a product of there being so much capital sloshing around in the economy over the past 5 years. But I think the advantage that Adam and I are really trying to hone is we do not have a fund in which we have to go rapidly deploy capital. And so if we can be patient, that will bode well in our favor. And that's something, that's a muscle that Adam and I are trying to develop, where we can move extraordinarily quickly when we see something we like, and we can get very creative on how we finance it, or we can sit back and pass on deal after deal after deal until we see something where we believe it's a great fit for us.
So I want to talk about everything post-acquisition and actually growing those businesses, because Decada companies have grown an average of 65% in our first year under our stewardship. So, and you put together SMB growth playbook, which consists 10 principles, but today let's cover the first 5. And the first principle is know the exact pain point you're solving. So could you explain this? And does this process of using this growth playbook already starts post-acquisition?
Yeah, so some backstory on both of those things. So first and foremost, we view year one as an opportunity to really alter the trajectory that the company has been on. Not because it's on a bad trajectory, but it was oriented around the seller, and we have this bold new vision for what's possible in the company. So what that means is we break a lot of traditional rules in the acquisition space, in the sense that, oftentimes the general rule of thumb is come in and listen and learn for several months and don't change anything until, and we are immediately jumping in and changing things. And it's often not as chaotic as that sounds. I think on the first couple of days, our job is to really earn the respect and trust of the team and excite them over why we're here and why we believe we can add value to them as individuals. We can help them make more money, we can help progress their career, and how we can turn this company they are hopefully very proud of into a company they can be even more proud of. And once we feel like we've built that trust and we've aligned on vision, we get to work and we implement a lot of change. Oftentimes that's on the technology side. Oftentimes their financials are a wreck and we need to kind of implement some gap accounting. Oftentimes there's a little bit of people change we have to go initiate, which is getting the right people in the right seats and making sure that we have a team that's just as excited about where we're headed as we are. And one of them, importantly, is what you referenced, which is kind of developing their go-to-market, I would say, their sales and marketing approach. This is something that I've been surprised is as absent as I've seen it to be, looking at businesses that are up for sale. Oftentimes I see companies almost brag in the sim that they haven't had to spend $1 on sales and marketing. And that's not an advantage to us. That's a disadvantage. That means they don't know how to repeatedly and sustainably go acquire new customers. And that's something we need to go develop. And that's hard to develop. It requires a lot of testing and piloting. And so I write a newsletter called Local Legends. It's kind of my personal way to wax poetic and be long-winded about things I care about related to company building. And the post you're referencing was actually taking an opportunity I had to speak at SM Bash a few weeks ago. And the topic assigned was the very niche and narrow topic of how to grow your business. So it's quite a broad topic. And, I'm sure the topic was landed on as a result of, sharing in our annual letter our growth rates. And we talk a lot about how focused on growth we are early on. And it was helpful for me to sit down and kind of take what's in our ethos at Decada and really try to distill it down to a step-by-step guide. And that was my attempt in the presentation. My presentation had like 130 slides in it, and I had 45 minutes. And it was a great discussion and a fun presentation, I think, with the audience. I wanted to almost get two birds stoned at once and turn that into a post where I can really kind of document this. And so I called it the growth playbook, the SMB growth playbook. Keep me honest there, Mick. It's essentially 10 principles that we wanted to really break down that we believe that any company needs to go focus in on in order to go drive growth. And so, the first principle was really know the exact pain point you're solving. A company exists to solve a problem. And that's the fun part of entrepreneurship is you're out solving problems for people and companies. And the bigger the problem that you're solving, the more money you're going to make, the more durable your company will be. If you're solving a discretionary problem with discretionary income, I would describe that business more as a vitamin than a painkiller. You're a solution to something small. You're a supplement, which is nice. A lot of people take supplements, but when times get hard, supplements are the first thing to go. On the other hand, you can be a painkiller. I think that most people intuitively know why their business exists. But we've found a lot of value in really taking a step back and getting very, very clear on why our clients hire us, what job they're hiring us to perform, and really building our product and service around that. It's very easy for a company to lose its way just slightly, and being even just a few degrees off on that can make downstream growth a lot harder to achieve. So that's where we started. It is the first step to driving growth is not jumping in and driving growth. It's ensuring you've laid a platform that allows for growth to really be unlocked.
I find this piece, SMB Growth Playbook, and I want to read first few lines from here because I believe this is a fascinating piece of copy you've put together, and this really got my interest, and that's why I wanted to talk about this on this pod. And you've said, most small businesses my team and I look at are not in control of their growth. They either don't know how to grow or they're growing and they don't know why. The lack of control creates risks. If a key client leaves, a salesperson quits, a new competitor emerges, or a recession hits, your business's fate could hang in a balance. Mastering growth puts you in a command of your business's destiny. Your goal is to create repeatable and sustainable ways to acquire customers, ensuring controlled growth. And after that, you have those 10 principles, which number 2 is creating your buyer personas. And maybe you can cover and share a bit what you mean in here.
Yeah, briefly, going further than just what pain point you're solving, the step from there is to really identify what trends you're seeing amongst your client base. And maybe you have one product and one buyer persona. You're selling a product or service into this demographic, into this geography, who tend to have this kind of job or income, who are looking for this kind of service. Oftentimes, though, you have multiple. I think in the post, or at least in the presentation, I broke down the various buyer personas of our electrical contractor, Northern Electric, where we have electronic or EV, electric vehicles, dealerships, EV dealerships who are selling Teslas and EV cars to their consumers. And oftentimes that buyer doesn't have a car charger at home. And so they need to partner with an electrician such as ourselves to go and dispatch and go help them install a car charger so that the car dealership can sell them a car. We have homeowners where the power goes out or something is broken and needs fixing. We have homeowners that want to do renovations and want to upgrade their home or need to do a renovation. And we sell into general contractors who are looking for a loyal sub. They each buy from Northern Electric for very, very different reasons. If you're an EV dealership, you want fast dispatching and you're not very price sensitive. If you're a general contractor, you want exceptional project managers who show up on time, end on time, and deliver within budget. If you're a resident, you want someone with exceptional reviews and a solid reputation because they're going to be in your home and you're opening the home to them. And you want them to also be able to dispatch quickly. And so the second step is once we really understand the pain point, understanding does that pain point change by persona, and what are those personas so that we can speak in their language. What good looks like here is an organization that understands that Sally is one buyer persona and Sally's look like this and we talk to them like that. And we also have John, who is, and if done really, really well, everyone from customer support to marketing to sales to support and delivery kind of identify, oh, this is Sally. And Sally really cares about these things. So it doesn't just align your service delivery and your ability to speak their language. It allows you to properly position yourself in order to be the vendor of choice when they go to hire your company.
Principle number 3, documenting your sales process. Why is it important?
Because most sales processes kind of suck and they're very disjointed. This exercise is a very enlightening exercise that we do post-acquisition, which is taking a bird's eye view and looking down on the sales and marketing journey. So essentially, from the moment they are a lead considering utilizing your services to the moment they transact with you, where are they going along the way? What are the touch points? And really mapping it out almost as like a Visio or Lucid chart diagram. And almost always, we are shocked at how convoluted it is and how difficult we are to do business with. And there are almost always immediate efficiencies you can go create to make it easier to do business with. And of course, that unlocks growth. That is a significant way to improve the leakage in your sales and marketing funnel. So really ensuring that you're not dropping customers off by being difficult to do business with. And that can manifest in so many different ways, but the way to really look at it plainly, objectively, is by plotting it out, and ideally doing that with your sales and marketing team, so you can all align around why we do things a certain way and why we don't do things a certain way, and what that translates in terms of being able to transact with the customer.
You've said here, create a process where your company is easy to buy from. Could you give maybe one or two examples where companies are really messing it up, making it very hard to find them or very hard to actually buy from them?
Yeah. I mean, it can be as simple as when we acquired Northern Electric. I believe their website was built in the 80s, and finding the phone number was not very easy. And it can be as simple as getting the phone number in the top right and having a web submission form. A more maybe nuanced kind of funnel drop-off area that we identified when we acquired Built by Design was we thought our buyer persona, we're a custom home builder, and we're one of the leading builders of micro housing in Utah. We found that the buyer persona we thought we had was a high net worth or high income couple who want to build a custom home, probably for the first time. We actually learned that the persona was architects who are usually the first stop that customers make when they're considering buying a custom home. They start with the design process and drawing up plans. And we actually learned that our persona was architects, and that if we wanted to grow, fostering relationships with more and more architects was important. So what we found is once we did that, we would have an initial consult with a customer where we would better understand what they want out of their construction journey, what they want out of the structure they're building, what matters to them. And oftentimes the next step would be, great, go back to your architect and let's start drafting plans. We hope to see you back in 6 to 8 weeks. And we found that when customers left us for 6 to 8 weeks, they were on a very long leash and they got lost in the forest, and sometimes made their way back to us, but oftentimes either met a different general contractor or shifted their plans during that process. And so we were able to implement weekly or biweekly check-ins with the customer, with the architect, with us, acting as project manager, ensuring that they're making progress and that we're maintaining a touch point with them along the way. So really just looking down at that process. And in an ideal world, you have technology that you can put data behind all of this. We got X leads, and that converted to Y web submissions, and those web submissions converted to these phone calls. And you can see and quantify what percent of each of the people at this stage actually make it to the next stage, and so on and so forth. And usually a close rate for a business is single digits, or 10 or 15%. So what that means is it goes from 100 to 10 to 15%. And if you can just optimize that just a little bit, that's one of the easiest ways to go unlock growth before you start investing aggressively on sales and marketing initiatives.
Then you have principle number 4, be where buyer personas congregate to drive demand. And here you've said that with discrete buyer personas established and your sales process documented, the next steps is determine where they spend their time. Can you please give examples about this and how you and your teams are using it?
Yeah, absolutely. Maybe Taylor Cooperative is the best example here. We learned that a lot of people are simply uneducated about the process of buying a custom suit. Either it feels stodgy and inaccessible, or it feels more expensive than it really is, or it feels daunting. And that a tremendous amount of research is put in by the customer online to go and read reviews, educate themselves. And that when our buyer persona for Taylor Cooperative is trying to select what suit shop to go into, they are online, they are searching for content, They are trying to educate themselves about the industry, about the product, and about who's around in Salt Lake City. And it's a very online customer, despite it being a very offline business. And so what that meant to us is we need to emerge as the best reviewed. We need to create a lot of educational content. We found also that the duration from someone considering buying a custom suit to actually coming into the shop is longer than one might think. They often think about it for a few months. And so retargeting them with ads, creating educational content, and emerging as today, we're the best rated custom clothier in the Western United States if you factor out California. And so really it allowed us to know where the customer is and ensure we're there and ensure we're helping assist with that buying process.
And the last one, last principle, fuel your business, invest to grow. And here, what you brought out, very interesting, raising prices. If you lose 20% of your customer base as a result of the price increase, but gain 10% new customers as a result of having budget to get in front of them, that's a significant net positive for your company. I find this to be a great example. So my question to you, how often do you raise prices on your portfolio companies?
Every time. I think every business we've looked at isn't charging enough. And I understand how that comes across. But especially in this climate where inflation was 9%, unless you raised your prices 9% last year, you lowered your pricing. And I truly believe that, especially in small business, your job is to be a niche player. Your job is not to service any and all. Your job is to really identify what lane you want to play in and play in that lane better than anyone else in the market, where some will scoff at your price, but your ideal buyer persona understands the value. I sometimes liken this to the iPhone. I'm shocked every time I go buy a $1,400 iPhone, and yet I've bought 10 in my life, and I'm never not going to buy an iPhone. And if you ask customers in survey interviews post-purchase, how do you feel about the price point of our product? Very underpriced, lightly underpriced, about what I would expect, slightly overpriced, or very overpriced. You actually want the majority of your customers to say it's priced properly, but you want a handful of people to say it's a bit more than I think it should be. And then you want to ensure you're delivering value. But it's the best damn suit in the market, and I understand why it's priced that way, for example. I believe it's in that section that I introduced this concept of the SMB, or the virtuous cycle of SMB, which is very integral to our overall playbook, which is there are vicious cycles where if you start doing one thing wrong in your business, it causes another thing downstream to go wrong, which causes another thing to go wrong. And all of a sudden you're in this that seems very difficult to get out of. On the other hand, there are virtuous cycles where if you're doing one thing right upstream, it causes another thing to go right, and it causes yet another to go right. And so the way we think about that is post-acquisition, we have to ensure that we're delivering a phenomenal product and service. And we have to make sure that we are exceptional at what we do. In doing that, we charge a price for that. We ensure we're charging a price premium because we can stand behind the product and service, which allows us to step 3, create better margins. And then we reinvest those margins. That's not so that Adam and I can go buy a private jet. That's so that we can then go reinvest those margins to carve out a budget for repeatable and sustainable growth. So allocating some of your P&L to really driving repeatable growth and reinvesting that margin into hiring really great people, because those really great people are going to deliver a phenomenal product and experience. And that phenomenal product and experience is going to allow you to raise your prices so you have high margins so you can reinvest. And all of a sudden you're in this virtuous cycle. That's one business strategy among many. That's perhaps not Amazon's business strategy where they want to be the lowest price. It's not Walmart's, but it's a business strategy that we've seen play out really successfully in small business and especially in our holdings. And so to come back to the exact kind of section that you quoted, yeah, it's quite counterintuitive, but if you run the model, break down the numbers in Excel or on a sheet of paper, if you lose 20% of your customers because of a 10% price increase, and you go look at the profit profile of the earnings you now make off of the 80% of customers who stayed, and the new 10% of customers who you're attracting due to investing in growth, the profit doesn't go up linearly, it's a step change. And so you obviously have to think about pricing in a very careful and strategic way. We don't blindly go in and raise pricing, but we run models like that to look at would it look like if we shed a portion of our customer base? And oftentimes there's a Pareto principle here, an 80-20, where 80% of your operational and customer service challengers are oftentimes from those customers who wouldn't even buy at a 10% price increase. So you don't want to service them anyway. That there's probably even a better provider than you in the market who should go service them. So it's really about leaning in, knowing your lane, and really being the best player in that lane you've chosen to be in.
The SMB growth playbook seems to be working like a magic. I mean, again, Decada companies have grown an average of 65% in their first year under following what you just said. So my question here and what we covered in the beginning as well, you have 24 hours on your day. You probably have been thinking about this as well. Running one business versus managing a portfolio of companies. If this growth playbook is working so well, why don't you go and acquire like a $20 million business and double or triple its revenue within 5 to 7 years and sell it?
Well, first of all, I'm not so sure this playbook would work at that higher end of the market. I'm not sure. I believe a lot of those principles translate to even billion-dollar companies, but whether our playbook would work as well in a different section of the market, not sure. And additionally, in order to go buy a $20 or $40 million company, we'd have to raise capital, which we're not interested in doing. But I understand your spirit behind your question, which the best possible thing you can do strategically as an entrepreneur or an investor is when you have a winner, go all in on your winner. You will make more money. You will benefit from the product of having a laser focus on your winner. And diversifying is not the goal. The goal is to go win. Our goal at Decada is not that we don't want to win. It's that we want to scout operators who they want to obsess over that company on our behalf, and we want to guide them and shepherd them toward the right opportunity. And additionally, our model works great even if we don't have a home run. And so we would rather have a more conservative playbook with our companies than be reallocating every dollar into each investment and trying to just push that envelope day after day. That said, there is a quandary with holding companies where the diversification is a major advantage. And perhaps the largest advantage and why holding companies exist is this concept that you can reallocate capital to its best and highest use across a very broad surface area. So to say that in less fancy language, if I go to each of my operators today and say, what are 10 investments you'd like to make in your business? Every operator would give me 20. So there's 20 potential investments. And what Adam and I can do is we can stack rank those, not within one company, but across our entire portfolio. And we could potentially take cash that's flowing out of one business and reallocate it to another. So that's a major advantage. A disadvantage to the holding company model is a lack of focus. And it is, at least for us, we tend to spend more time on our companies that are experiencing a challenge than investing time into our winners. It's quite a dichotomy. In an ideal world, we're blowing wind into the sails of our best companies. Yet instead, our time is currently today allocated in getting companies on the right track when they've stepped off the trail. So yeah, I think that sometimes I describe our holding company as like a lifestyle business. You know, we're not selling surfboards on the beach, but we don't exist to go maximize shareholder value. You know, we don't exist to go maximize a market opportunity. We have to run financially prudent and be good stewards of our companies financially. And we have to have a good business sense. I believe there's a little bit more to life, and I want there to be a little bit more to my life and my career than going and trying to maximize a market opportunity. If that's your goal, and that's been my goal multiple times in my career, it's not a bad goal. If that's your goal, don't start a holding company. That's not the model to pursue. And I do believe, for what it's worth, just speaking candidly, Taylor Cooperative would be much bigger and it would be thriving had we not gone and acquired 3 other companies. But that said, today we now have an asset that is quite valuable to me and Adam, that is diversified, and we're back to the moment where we can be reinvesting aggressively in Taylor Cooperative's growth. So everything comes with trade-offs, and the holding company model is not the best model out there. It's a model. The job of an entrepreneur is to identify what you value and create a company, a business model, and a capital structure that aligns to what you're trying to get out of your journey. And I think entrepreneurs would benefit being a little bit more thoughtful about what they're trying to get out of their experience, and almost setting that 10, 20-year goal and working backward to figure out what you have to do today to start inching toward that.
You mentioned 10, 20-year goal. What is, let's maybe ask this way. What motivates you today? What do you want to accomplish next? And what is the future for Chase and your businesses?
Yeah, I mean, what motivates us today is we have a lot of companies that are a craft. Making a custom suit is a craft. Art is a craft. And I think that Adam and I over the years have unintentionally fallen into this appreciation and love for the craft of company building. There is a way to build a company intentionally and do it right for the sake of doing it right. And I think that's in part why I'm trying to write my newsletter, Local Legends, is really examining the art, the craft of company building, for lack of a better word. And I know that sounds cheesy, and most suit makers and artists would laugh me out of the room, but I do believe there is an art to company building, and you can take pleasure in building intentionally and doing it right. And that is really motivating, finding better and better ways to run our businesses every day. I think we're incredibly motivated by supporting our operators and watching them develop as leaders, and helping them go make a ton of money and have life-changing outcomes, and watching our operators, really provide for their families and live a great life. There's an entrepreneur I really look up to out in Utah, and I heard him say about 10 years ago, his number one motivator and his metric for his success in life was how many millionaires he creates along the way. I always really liked that. He's in software in an incredibly large market, and he's exited 2 large tech companies. So maybe he's playing at a different scale, but what an incredible thing to do is to, really create good outcomes for the people who choose to build alongside you. And so Adam and I really care a lot about working alongside good people, building good businesses, doing it in a way where we enjoy those people and we enjoy the process. And I know I've said it a few times, but really building a day-to-day and a lifestyle we don't want to retire from. So looking ahead, I think my biggest fear is that we lose some of that. And I think we have a lot of work to go build more resiliency in our companies. We acquired 4 companies in 3 years, and that was quite expensive. And so we have a lot to do on kind of rebuilding the capital coffers, strengthening our balance sheets. And so we're definitely practical. We definitely have to run financially strong organizations. We're not just talking about creating a better Salt Lake all day and navel gazing over the art of company building. We have to be out there working, and we are. And so long term, I think we want to continue to acquire great businesses. Would love for really us to have a diverse and eclectic portfolio of companies that truly make Salt Lake and make it a better city, and that we get opportunities that maybe one day we feel we don't deserve, to really kind of steward a company that could be quite meaningful to us and to the community, and learning along the way how to actually be good stewards and good owners as we go. So it's a very long and kind of poetic way of putting it, I know, but that's really what we're after, is keeping it fun, keeping it intellectually engaging, working with great people along the way, and trying to not get sidetracked and not have too many of our businesses fail along the way. That's the model.
That's perfect. Knowing you a bit more than 60 minutes and having this conversation here, you seem very happy, very relaxed, and you really know what you're doing. How has entrepreneurship and building Decada Group changed your life and changed your family life?
That's a good question. I haven't thought about that too much. I think I was very fortunate in life in that I was able to find my superpower, for lack of a better word, early on, and that was entrepreneurship. I look at peers and siblings and folks I've mentored, and oftentimes it takes a really long time to go figure out that intersection of what you're good at and what makes you money and what gives you purpose. And accidentally, I learned that at age 19, and that was a great head start for me, and I really appreciate that. I'm really grateful that really happened. And so, Nick, forgive me. What was your question?
No, it's how has it changed your life? And but you already said you're happy that you found your passion, your journey, your route at a very young age, and I think this is Perfect.
Yeah, hopefully you can edit out the brain fart.
Yeah.
I think that, yeah, to add one more thought onto that, I think there's something very purposeful about being aligned with what you're good at, what makes you money, and what gives you purpose. I think as a society, purpose, I believe, is directly correlated with happiness or joy, and feeling like you can create something and build something that potentially outlasts you. And so it's been very fulfilling. I think it's been very challenging. There's definitely been times in my career where I have not been anywhere near as balanced. Again, I think hopefully I was able to illustrate that that's almost why we created Decada. Mm-hmm. And so we're a work in progress. I'm a work in progress. There's a long road ahead of us, but I really am proud of the fact that Liam, my son, gets to see me passionate and fulfilled. I walk him through our businesses from time to time, and the amazing thing about having children is he doesn't give a shit about our companies, and he does not want to be the heir to Decada Group. He's made it quite clear he wants to be an actor, and he doesn't like the idea of going into business. But I think it's valuable for our children to see ourselves at our best and really enjoying life and trying to get the most out of it. It affords some good downtime as well. I was able to go and take my son out to Japan, as you mentioned, a couple weeks ago, and we were like two little 11-year-olds wandering around Tokyo and Osaka, and took 2 weeks to really do that. And I'm not sure I would have that opportunity had my career taken a different route. And so, yeah, it's a result of a lot of sacrifice and a ton of luck. But I think that's the beauty of entrepreneurship. I feel like everyone should be an entrepreneur. And I think there's tremendous value in being in control of your life. And there are very hard moments. And there are moments that feel very scary, and that sometimes I'm not so sure I took the right route. But there are also many moments where it's the opposite. And so it enriches life. I think an entrepreneur's life has more color in it than maybe a corporate executive's life. I'm not sure. I've never been a corporate executive, but that's my belief.
Chase, it's been a good fun. Let's wrap up with a famous five. How old are you?
34.
Favorite book?
Let's see. I read a lot of Hemingway. I'm a huge fan of Ernest Hemingway, as you'll see behind me. Love his writing. He's a 20th century Renaissance man, and I've read all of his books and visited many of the sites to see. A book that I end up giving in more of a professional sense is for those interested in this kind of genre of our conversation today, Mick, there's a book called Small Giants: Companies That Choose to Be Great Instead of Big. I may have butchered the subtitle, but it profiles 7 companies or 9 companies that turned down opportunities to be large in order to preserve something that was important to them. And it profiles how they made that decision, what kinds of companies they have, what that translates to from a financial perspective, from a community perspective. And it's called Small Giants. And if you're ever in the Decada office, our password for our Wi-Fi is Small Giants. So I've given that book out to dozens of people.
Married, single, kids?
Divorced with an 11-year-old.
What car do you drive?
I drive a Volvo, a CX-60, I think it is. I definitely would feel disingenuous arriving to our electrical shop in a nice luxury vehicle. But I like a nice car. And I have a conservative Volvo, a very boring old man car, but I drive a Volvo CX-60.
What's the best investment advice you've ever got?
Oh, interesting. The best investment advice I've ever gotten. You may have stumped me here, Mick. Let's see. Man, I think it comes back to what we were talking about 10 minutes ago of being able to structuring yourself in a way where you can be patient. When you raise a fund, you have an obligation to go and deploy it. When there's a business that's pretty good, you're inclined to just take it down anyway because it's right in front of you. And this concept, I think it's a Buffett quote. We can't complete an episode without a Buffett quote, Mick. I believe it's, be fearful when others are greedy and greedy when others are fearful. And to me, that in part encapsulates patience and the ability to kind of swim up when people are swimming down, so to speak. And so, yeah, I think structuring in a way in which you are allowed to be patient, I believe is really, really good investment advice.
There are some folks listening, maybe wanting to reach out to you, ask a few questions, where they can find you.
I'm writing actively at Local Legends. If you just search Local Legends in my name, it'll come up. I'm active on Twitter, so that's maybe a good place to start. I'm just Chase Murdock on Twitter.
Perfect. Again, thanks a lot, Chase, for doing this. When I was reaching out to you, I was looking at your profile. You were traveling, doing all sorts of things. So I was like, you must be an awesome guest, and you 100% were an awesome guest.
I appreciate you saying that. Thanks for all you're doing to build this podcast, and it's been a fun conversation.